From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day. It's Friday, May 6th. Here are the top market stories we're following for you at this hour. Another growth spurt. Non-farm payrolls increasing by 428,000 in April as wage growth moderated in an extremely tight labor market. We're going to break it all down. Friday blues. Market sending another risk-off message from stocks to bonds as the sell-off continues in what's been a very volatile week. And those supply shocks, they continue. Lockdowns in China and stretched supply chains have left companies around the world in a bit of a bind. We'll discuss with Kurt Sievers, NXP CEO. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guy, another risk-off day in the markets. A lot of this seems to have been turned around, or I should say snowballed, coming off of this jobs report. Good news on the surface, not so great under the hood.
Yeah, you look under the hood, I think it's terrible, to be honest. Everybody's saying this is a great jobs report, and it is. The U.S. economy is employing a lot of people, but it's not employing enough people. And there are bottlenecks all over the place, and it's in the labor market. And you talk to any CEO, and you'll get the same answer. I am struggling to hire people. So U.S. employers, let's deal with the numbers. U.S. employers added 428,000 jobs in April. So that exceeds estimates. Great. It wasn't a blowout, but it was a good report. It's above 400,000. I think it's 12 in a row now, but it's a good report. But here's my question. Look at the participation rate. It didn't go in the right direction. We were hoping participation was going to improve. It didn't. It went the opposite way. So here's my question for the day. Why are Americans not going back to work? Let's bring in our international economics and policy correspondent, Mike McKee, who is in Palo Alto, California, Yelena Shulyatyeva of Bloomberg Economics. Mike, let me come to you with that question. Look at the participation rate. Why are Americans not going back to work?
Well, I don't know what you're talking about, Guy, because I was here at 3 a.m. But hey, a lot of people...
You're doing two people's jobs, I'm
dropping
sure.
out of... a lot of people dropped out of the labor force, according to the statistics this month, but that may be just a statistical discrepancy brought about by seasonal factors. We don't know, and 1 month doesn't a trend make. More than 400,000 jobs a month seems like it's not that high anymore because we've had 12 months of that many people going back to work. But at this point, you've got a combination of retirements, people in the baby boom who were retiring anyway. The labor force participation rate going down for a long time. And then just people who are either deciding they don't want to go back to work yet or just waiting for a better job. But we're still hiring a lot of people. It's just that there's just a lot more jobs open than there had been before.
Yelena, hop into this conversation here. There's a lot to digest in this jobs report, and I'm curious what the biggest thing to watch for here, because you have moderating wage growth, but you also have a labor participation rate that's changed as well. So put this into some context for us. What's the biggest issue with this jobs report today?
I think it's an interesting report, overall strong labor market, but I totally agree with Michael that we saw tick down in participation on the back of increases in the previous 3 months, which we saw an increase of 0.5 percentage point in participation already. We just stepped down by 0.2%. I think the thing to watch is definitely wage growth, and I think that will start to decelerate from now on. I think it is peaking at this point. We will see some moderation in payrolls growth going forward.
Yep.
And we will see participation gradually continuing to improve.
Yelena, there are 2 jobs for every unemployed person in the United States. Everybody's made much of that statistic this week. This is why I'm focusing on the participation rate. And I think it's interesting what you say about wages peaking. Why will wages peak when employers are still so desperate to employ people and can't find the staff to fill those positions?
Well, you really have to be very careful about these job openings numbers. There's a lot of anecdotal evidence that they might be overstating the true picture of what is going on in the labor market. I think the Fed just really, Mr. Powell made it very clear the other day that they are intending to put some pressure, cool down demand, and this way openings will go down. But at the same time, I think there is still a good chance that participation will keep going up. And this way we will bring the labor market more in balance. And this way, wage growth will remain strong, but probably it's not be as strong as we have seen it in the last few months.
Mike, hop back into this conversation here because I'm curious about the market impact. We're seeing a major sell-off when you look at the stock market, a major sell-off when you look at the bond market. What is it that we need to really be trading off here? There was a time when the surface payrolls number or even real wages was the driver for the markets, but I'm very confused as to what exactly the market is actually looking for here.
So am I, Critty. I don't really know. And what's interesting is this is a conference that features a lot of people from the Federal Reserve. And I was speaking to one senior Fed official last night who said, what's the market doing? They don't know either. It appears that what we're seeing is sort of a realization that maybe things were overvalued and maybe in the new world of higher interest rates, your discount is going to be different and you've got to bring down the price a little bit. And everybody's trying to do that at once. Throw in the confusion you get from all of the automated trading these days, and you end up with something like we've got right now, a lot of volatility around what's going to happen. And it'll take the markets a while to reprice, to try to figure out exactly what you should be making in terms of return when you're in a world of higher interest rates like we're going into. One thing I think that I wanted to add that you had asked Yelena about what to watch in this report, we may be starting to run low on workers who are ready to go back to work. And in certain areas with certain skills, 1 month doesn't make a trend, but only 2,000 construction workers. So is that because they're getting harder to find? They've been in short supply, or is that because we're starting to see the interest rate effect of higher mortgage rates on the planning that builders are making for how much they're going to do going forward?
It's funny, Mike, we're going to talk to Gina Raimondo, the Commerce Secretary, in the next hour, and she's not the Labour Secretary, but it's a relevant question for her, I think. Are we starting to end up in a situation where we do have a skills gap, and what can she, as Commerce Secretary, do about that? Mike, CPI next week, the survey is 8.1, that's down from 8.5. What are people saying at the conference that you're at about the trajectory of inflation here? What are people saying as well about Powell's decision to take 75 basis points off the table?
Well, nobody really thought 75 basis points was ever a serious proposal. And even Jim Bullard wasn't endorsing it. He was just saying he wouldn't rule it out. I think the market got ahead of itself in thinking that way. The Fed does want to move expeditiously, as they said, and 50 basis points was a big change, especially when you're going to do it for a couple months in a row. So I don't think that that's going to be an issue that will really be front of mind here. But everybody's thinking that maybe inflation has peaked. So we're going to want to see if that's the case. Now, headline inflation may not because of the war. We have the potential European embargo of Russian oil that could send oil prices significantly higher. So the headline, obviously, is something that nobody can control. What'll be interesting to watch is the divergence between headline and core. If core doesn't rise as fast as the headline, that would be a little bit better news on the inflation front for the Fed.
Yelena, I want to ask about the 75 basis points that Mike was just talking about. Is there any chance the 75 basis points, despite Chairman Powell coming out and saying this is off the table, is there anything that would bring it back on the table?
I mean, there's always a risk scenario, obviously, but I think it's a tail risk at this point. Chair Powell said 50 basis points at the next two meetings. After that, I think they will stop and reassess the pace of further rate hikes. And I think at that point we will see inflation has moderated. We think that CPI has peaked. So I think 25 basis points going forward is our base case scenario.
Well,
Yelena, one final quick question from me. Was Powell hawkish or dovish this week? Can you just kind of give us your sense of that?
Well, Chair Powell was just really honest, I think, in a sense that he said, okay, this is what we did. This is how we, saw it back 6 months ago. And we are going to be data dependent. He's as honest as he can possibly be. I don't think he was very dovish or hawkish. He just, told us the facts. And the facts are inflation may be moderating, and they will reassess, when we get to that point in a few months.
Bloomberg's Michael McKee and Yelena Shuletieva of Bloomberg Economics. Thank you both so much. A really fascinating conversation on the Fed and, of course, the jobs report as well. Coming up, we'll have more on that conversation with Matthew Hornbach, Global Head of Macro Strategy at Morgan Stanley. Stick with us. This is Bloomberg.
The labor market is very, very strong right now.
This is a very strong labor market.
It's a white-hot labor market.
The labor market is white-hot.
This is an economy and a labor market that's overheating.
The economy is red-hot. The labor market is red-hot.
Those were Bloomberg TV guests on the health of the U.S. labor market. Let's get a little bit more insight now from Matt Hornbach, Morgan Stanley Global Head of Macro Strategy. Thank you, as always, for joining us. Matt, it's been a rough couple of days when you look at the markets, stocks, bonds, these extreme sell-offs, a lot of these flows going into the dollar. I'm curious where the labor question really falls into it. What are investors reacting to here? Is it the 75 basis points? Is it the payrolls number? Is it the labor participation rate? Your take.
Creedy, thanks for having me on, and happy Mother's Day to all of the mothers out there, including mine and my wife's. I think in terms of what the market is reacting to really is the future, and what's coming up next week is probably more important than the labor market report. That's the CPI inflation report. We've had a couple of, inflation reports here. I'm thinking about the PCE numbers that we've gotten over the past 2 months, and they have been more reasonable reports than what we had over the 4 months prior to that. Chair Powell did reference that. So I think ultimately it comes down to inflation, Creedy, and next week's report is going to be very key to markets going forward.
What do you think that number's going to look like, Matt?
Well, Guy, we think it's going to be a good number. I mean, ultimately, the trends in underlying inflation in the U.S. are strong, particularly with the housing market. In the last segment, I saw you talk about home builders. That component of inflation we expect to continue to be quite strong. So underlying inflation should hold up, Guy, but it's really about all of the other factors that had been boosting inflation towards the end of last year, early this year. That's really where the rubber is going to meet the road.
Matt, I'm curious about the currency picture here. If you are starting to see a lot of these investors hop out of stocks, hop out of bonds, and go to cash, is the dollar here a no-brainer trade?
Well, I mean, ultimately, the dollar is rallying on a combination of factors, as it usually will move to. One, of course, is the policy divergence that we see being put into place by the Fed against the Bank of Japan, against the ECB. Against the PBOC in China. You also have growth elements that favor the dollar currently. Those include certainly strong growth in the U.S. economy, the labor market report this morning, a hat tip to that idea. But then when you move overseas, you do see weakness in China. There's concerns about the zero COVID policy approach in the marketplace. And then, of course, there are concerns about what's happening in Europe. So the growth expectation channel also has been favoring the dollar of late.
Matt, do you think we're still underpricing the Fed? Like, how far does the Fed need to go here? You've got Kashkari on the tape now talking about the fact that we basically need to deliver on the forward guidance that has been laid out by Chair Powell. Where do you think ultimately this takes us? How high do rates in the United States need to get in order to deliver the demand destruction that the Fed needs to see?
Well, Guy, I mean, that's a problem that's multivariate. If I just look at the U.S. economy, I think the Fed could very easily get back to where it was in 2018 without really causing much demand destruction. Morgan Stanley economists led by Ellen Zentner are looking for the Fed to go higher than that. And I think that seems completely appropriate at this stage in the game. But when you broaden the lens and you look outside of the United States, that's where the waters get more muddy. And I think ultimately the U.S. the U.S. economy does operate more on an island than other parts of the world. But, as we make our way deeper into this year and we get to see what exactly transpires with China, what's happening in Europe, then I think we'll be in a much better place to know, does the Fed have to go into restrictive policy territory or not? And I think the same holds for the Fed.
Matt, I feel like you hit on this really key point that the U.S. does kind of operate on this island. It's interesting that you talk about the recession chances because it almost feels like the consensus here is that recession isn't in the cards for the United States unless the Fed does something out of the ordinary. But Europe, China even, the export picture that comes out of there, the inflationary picture, particularly out of Europe, is concerning. Recession is on the table for those two economies. And I'm curious how much of that can actually drag the United States down as opposed to the other way around.
Well, Kriti, that's exactly why we have to pay very close attention to financial markets, because the transmission channel, typically from outside the U.S. into the U.S., you're right. I mean, exports and global trade, that's a key component of the transmission mechanism. But financial markets are also a key contributor to that transmission into the U.S. economy. So if the equity market continues to trade on the weak side, which is what our chief U.S. equity strategist, Mike Wilson, is looking for, then that could have an impact on the U.S. economy much earlier than any traditional economic analysis would suggest.
Matt, let's just talk about some other central banks. Kriti brings up what's happening here in Europe. Bank of England yesterday. The Bank of England signaled a recession and hike rates. How many more rate hikes do you think the Bank of England is going to have to deliver? We've got inflation heading for double digits. That's emerging market territory. The bank then expects that inflation picture to absolutely collapse as demand gets crushed. In order for the bank to deliver on its mandates, in order for it to do the right thing for the UK economy, what are you guys now thinking? What do you expect to happen, and how are you going to be? How should one position around that story?
Well, Guy, if the message from the Bank of England sounded confused, I think it just reflects what most investors are thinking these days. People are very confused. Now, in terms of what we're expecting, we do see another hike, but after that, we don't really see much from the Bank of England because we do have growth coming down quite substantially. So when you look at Morgan Stanley economics and their forecasts for the Bank of England policy, a bank rate in this case, we're way below where the market is currently priced. So one of the key recommendations that we are out with after the Bank of England meeting is for investors to be in yield curve steepening exposure. So to be long 2-year gilts versus short 10-year gilts, looking for that particular part of the curve to steepen up. That's a key message from us in the wake of that meeting, Guy.
Matt, great to catch up. Always useful to get your analysis as to what is happening here. And then critically, how to position around it. Matt Holmback, Morgan Stanley Global Head of Macro Strategy. Sir, thank you very much indeed. What have we got coming up for you? Could yesterday's sell-off be all about ETFs cashing out? We're going to talk about the role they've played in the story you see on the screen in front of you. That's next. This is Bloomberg.
It's time for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Shares of Under Armour are falling. The athletic wear maker's forecast showed it's struggling with supply chain issues. The company's also being hurt by pandemic-related shutdown in China. Shares there were down some 14% in the quarter. Tesla's making plans to resume double shifts at its factory in Shanghai as soon as mid-May. Bloomberg has learned that the electric car maker expects labor and parts shortages to ease. The factory was shut for 3 weeks last month when Shanghai was hit by a coronavirus lockdown. It resumed limited operation in late April. And a group led by former Guggenheim president Todd Bowley is close to an agreement to buy English football football club, Chelsea, one of the most successful of the past 2 decades. The prize is certain to be the highest ever paid for an English club. Russian billionaire Roman Abramovich put the team up for sale in March, just before he was sanctioned by the British government. And that is your latest Business Flash. Kriti.
Ritika, thank you so much. Well, it's been a volatile week in the markets as traders assess how central banks are affecting price levels. Bloomberg News' Katie Greifeld looking at how the swings played out in the ETF space. Katie.
Well, Kriti, you saw ETF volume absolutely soar yesterday. You saw the same thing in January, in February. This tends to happen when things get a little bit hairy in the markets because ETFs, they trade like water. They are so incredibly liquid. Traders tend to gravitate towards these tools when there is that sort of high volatility. Now, you typically see these big volume spikes precede a bottom typically, but that obviously didn't happen in January. It might not happen now, given the macro outlook, which of course, it's caught a lot of investors off guard. A ton of money this week has flowed into junk bonds, into leveraged tech, and into the ARK Innovation ETF. That had added up to a lot of pain yesterday. And what caught my eye in that chart is that you actually saw traders pull money from the ProShares Ultra VIX short-term futures ETF. And that's surprising because that fund actually crushed it yesterday. The ticker there is UVXY. It soared 37% yesterday alone. It was the best performance by a mile among U.S. ETFs. It's up another 4 or 5% today. We'll see if inflows follow.
Okay. Katie Greifeld.
All right.
Thank you very much indeed. I think we're going to see a bumpy week next week as well. And I think this is stopping anytime soon, judging by the price action that I'm seeing on the screen in front of me. NASDAQ all over the place, down hard, bouncing back. We're down by around 0.8% right now. We're going to talk about one of the components of the tech landscape next. NXP reporting strong results this week. We're going to discuss the outlook. What is happening with this global chip shortage, particularly in the automotive sector? Kurt Sievers is going to join us from NXP. I have to say, the CEO of Volkswagen thinks that things are going to improve in the second half of the year. He's expecting more chips. Is he going to get them? We're going to ask Kurt Sievers that question next. This is Bloomberg.
We're an hour into the U.S. trading session. Bloomberg's Ritika Gupta is tracking the moves. Ritika.
Yes, Kriti. Well, we do continue on that downward trajectory. You can see we are clearly in the red, maybe erasing some of the losses, but investors really trying to find some safety here. Of course, they took little comfort from that jobs report, maybe okay on the surface, but beneath that labor participation rate looks like the Fed is ultimately going to stick on its course with those aggressive rate hikes. You see tech, though, having another bad day, down some 1% here. And that's really we was looking at when we came into this session that we could perhaps be flat on the week, but we're really going to have to see how it goes today. Certainly looking like we are going lower, but adding more pressure to that, of course, is the yield, particularly that long end, that 10-year now at 3.07%. So continuing to move higher. And of course, we can't talk about a risk-off day when we're not talking about Bitcoin selling off. So that's down some like 1.7%, really trading in tandem with risk assets and some of those tech stocks as well. Now, we've got to focus in on bonds. This has been, as we talk about the sell-off in stocks, we also talk about the sell-off in treasuries as well. When you see that yield on the 10-year, on the long end, up in the past 2 days, up some 18 basis points. So some big moves here. If they're not going, investors not going into stocks, they're not going into bonds, where are they putting their money? Perhaps cash, perhaps King Dollar as well. Now let's just finally just end here looking at the tech sector, of course, having a bad day, having a really bad year, of course, down some 22% or so. But what you can really see is the white line here, and this is your semis, your chip makers, and this has really dragged that index lower on the year. So a big part of that is the chip makers pulling them down. You did have Anastasia Amoroso, though, on the open this morning saying that maybe with lower valuations, that could be some kind of an entry point here for the chip makers. But I know you will discuss all of that and more. Back to you, Kriti, Guy.
Bloomberg's Ritika Gupta, we thank you so much. Let's stick with that chip story. NXP Semiconductors recorded impressive first quarter results. Its second quarter revenue forecast better than expected. Joining us now is the perfect guest. Kurt Sievers, NXP CEO, joins us right here on set. We thank you so much, as always. It's a fascinating time to talk about chips, just given this environment. We've been having these chip shortages for, I want to say, going on a year and a half now, at least. I'm curious, though, I'm just looking at our FA function on the Bloomberg terminal. 38% of your revenue comes from China. We're talking about COVID lockdowns, restrictions as well. How much does the China story affect you overall?
Yeah, so first of all, thanks for having me again this week, Kriti. It's indeed a world in turmoil, I would say, from a supply chain perspective. And the latest addition is the situation in China. In our particular case, we do not see any demand impact in the second quarter, which we just guided earlier this week. We do see, however, some risk on supply because some of our suppliers in epoxy, in substrates, which are located in the Shanghai area, have been impacted by the COVID shutdowns. So we factored in some risk adjustment to our second quarter guidance in order to cater for that. But again, it's not on the demand side because we've been under shipping the market for 1.5 years now. So people just try to get every device we are shipping. So there is no demand impact. And with that, we again guided strong for the second quarter with 26% year-over-year growth, including China.
Okay, Kurt, let's talk about that underdeliverance and the demand that we are seeing. What happens in the second half of the year? So up in Wolfsburg, Herbert Diess thinks things are going to improve. He's expecting that he's going to be getting more chips for Volkswagen. Is he going to get them?
He will get more. And not only Volkswagen, but the whole industry. So in our guidance, we also talked about the second half of the year being bigger than the first half of the year. Yet, I have to say, the whole year for NXP, we will continue to be sold out, which means our growth, our revenue growth this year will continue to be gated by supply only. However, every quarter more than the previous quarter. Q2 will be above Q1. The second half will be above the first half, and that is strongly led by supplies into the automotive industry.
Kurt, are you charging as much as you could right now? And if not, why not? And if you're not charging as much as you could, does that imply that you're a little bit concerned about the cycle?
So first, we do not charge as much as we could. What we do, and that's a very strong and very transparent policy, the rising input cost which we are experiencing from our suppliers, from labor cost, from energy cost, we are passing that on to our customers, but just that much that we can protect our financial model and our gross margins. We do not do this in order to pad our margins. And Guy, I'm a big believer in that policy because in the business which we have, and automotive is a good example, but also the large industrial customers, we have very long and very important customer relationships. So it is not a reflection of the cycle. It is purely a reflection of how much I personally and our team, how much we honor our customer relationships, because you talked about Volkswagen, other car companies. I want to be in business and I want to be their good supplier and trusted supplier, not only for next year, but for the next 10 years.
Kurt, you were talking about demand not being impacted. Supply is really the issue here. If you can't meet capacity, what kind of time frame are you looking at to get back online in terms of getting to 100% of what NXP can offer?
Yeah, so we think currently that, as I said, this year clearly not. It is gonna good improve next year. I mean, it all depends on how the demand continues to go, but I believe with the strong continued penetration of xEVs, for example, which need much more chips than conventional cars, the demand will continue to be strong. So I started the far end, Kriti. I think in 25 we will be certainly fine. I hope we can be fine in 24, but I think 23 will still be a challenging year.
Where are you said a moment ago that you were focusing on pricing because you want to be in business with your customers for a long time. Kurt, where do you think we are, though, in the cycle? There's serious recession fears here in Europe. What do you think the macro backdrop looks like right now? Where are we in the cycle? What kind of a cycle is this?
Well, from a semiconductor perspective, which has always been very cyclic, I do believe the semi industry will continue to have strong cycles. However, where NXP is operating in is a subsector of the semi industry, which is about these trailing edge nodes. and which is about, from a market perspective, automotive and industrial. So 2/3 up to 3/4 of the revenue of NXP is in automotive and industrial. And given that most of the capex which is currently being spent in the semi industry goes into leading edge nodes, which do not help the supply shortages which we have, I do not think that we see anything like a hard landing or soft landing anytime soon. So I think we have a pretty strong ongoing demand pattern also through the next few years. And that also comes then back to the pricing. So I think the pricing levels which we are achieving this year will continue to stand over the next years. Again, this is not a statement for the total semi industry. It is a specific statement to where NXP is operating, given the overly strong exposure to trailing edge nodes where the capacity continues to be constrained.
Kurt, I'd like to ask you about the sourcing of metal. We know that metal prices and commodity prices have risen around the world, a lot of that in response to the war in Ukraine. But for chips, that's an extra burden on top of the supply things. How much of the supply chain in terms of sourcing metals specifically are you adjusting? Are you looking at other countries, for example?
Metal isn't really our concern. There is one concern which came up after the horrible invasion of Russia in the Ukraine, which is neon gas. So we need noble gas, especially neon, which is largely coming from Ukraine and Russia. The good news is the industry has strong buffers. So we have the time now to actually look for alternative sources before this might be totally cut off going forward. So from that perspective, I think we are not in the worst place as an industry.
And I mean, you talk about the metals and that, or the gas part as well, eating into it. I want to ask about your margins, though. How much longer can you perhaps pay extra for some of these raw materials?
That comes back to what I just discussed with Guy. We will continue to protect our financial model by raising prices in line with the increased input cost. And that's a matter of fact. Energy prices at large are going up. Even labor costs here in the US, we have 3 large facilities in the US, in Arizona and in Texas. Labor cost is going up. But so far we've been successful to pass that on, but not more than that. It's really important to say we keep a fine line here. But I'm confident we can continue to do this because the world needs chips. The world is short of chips, so we can command the price which is fair.
Kurt, we're going to be speaking to the Commerce Secretary, Gina Raimondo, in the next hour. She is actively trying to push legislation, a bill through the houses of Congress that is going to allow the US to support the chip industry in its reshoring efforts. What do you make of the efforts thus far? Are they going fast enough? Are they going to have an impact quickly enough? Talk us through what you think the government is doing and what it could be doing still.
I&V are a very, very big supporter of the CHIPS Act. By the way, not only in the US, there is a similar situation in Europe, which followed swiftly to the US. I think it got significant momentum, and without being able to give you specific detail, we are significantly participating in this. One reflection is that large US customers are demanding US soil chip production for big new deals, which they would be awarding for the years 2025 onwards. So we are now working on design wins for that time frame, and our US customers are having an absolute requirement that the chips which we will ship then are manufactured in the US. That can only be enabled by the CHIPS Act, which you mentioned, and I see that system is at work. It does work, so I'm not only supportive, I'm also thankful to it because I think it's absolutely the right way to do it.
Kurt, we'll put those points to her. Thank you very much indeed. Greatly appreciate your time. Thanks for dropping by. Kurt Sievers, the NXP CEO. Thank you, sir. Coming up, we're going to take you back to China. Lockdowns in China continue to slam manufacturers. The CEO of a major supplier to household names such as KitchenAid, Pyrex, joining us on the impact on his business. Ravan Gandhi of GMM is going to be joining us. That conversation coming up. Got lots to talk about. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta. You're looking at a live shot of the principal room. Coming up, Stanford University Professor of Economics, John Taylor. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The EU has proposed a revision to its Russian oil sanctions ban to give several countries more time to comply. Bloomberg's learned that Hungary and Slovakia would get an extra year until the end of 2024. The Czech Republic would get an exemption until June of that year. All other EU members would phase out Russian oil imports by the end of this year. The United Nations says global food prices continue to hover near an all-time high. The crop trade has been disrupted by the war in Ukraine. The country has been one of the world's largest shippers of wheat and vegetable oil. High fertilizer prices and drought have added to that problem. And the U.S. labor market kept expanding at a robust pace last month. Plus, wage growth moderated, but a surprise drop in the participation rate suggests the labor market will remain exceedingly tight. The economy added a better than expected 428,000 jobs. The unemployment rate held at 3.6% as the size of the labor force declined. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Okay. Ritika, thank you very much indeed. Let's talk about what is happening in industry. We've talked to a number of CEOs over the last few days. Consistent themes keep coming up. What's happening in the labor market? What's happening with supply chains? What's happening with China? All of these seem to be reasonably consistent and everybody is struggling with it. GMM Non-Stick Coating says some of its most reliable clients are beginning to not be as reliable. The company is a supplier, of course, of houseware names such as KitchenAid, Pyrex, Black & Decker, and many, many more. Raveen Gandhi, the company's CEO, joins us now. Talk to us about why that is the case, Raveen. Why are some of your customers starting to struggle?
So if I'm an optimist, I basically say that it's supply chain and people order too much stuff in Q4, and that is inventory sitting in warehouses now, and that's why things are slow. We're down about 11%. That's what we think that we're going to be down for 2022. That's if I'm an optimist. If I'm kind of a pessimist or even a realist, I say there's some very troubling signs that I see. We have a lot of clients, like you mentioned, that are very reliable, where we can predict their ordering pattern, and we are seeing air pockets where people suddenly just stop ordering for 30 days, 40 days with very little explanation. And honestly, the last time I saw patterns like that was around 2008 or 2009. And I hope we don't get there, but it's quite troubling to me right now.
Raveen, are you saying that we're headed for a recession in the United States, perhaps?
Yes, that is what I'm saying. I think I hear a lot of denial. I hear a lot of anger. I hear a lot of bargaining. And I think the market's telling us it's time to have a little acceptance. I think that the consumer is stretched tremendously. I think this Fed has been accommodated for the last decade. I think they're taking the punch bowl away. And from where I sit, it's just really hard. We see slowness in the EU. We see slowness in Asia. We see slowness in America. And, every day 40 million people use products that have my coating on it. And so let's say you have a pan or you have a grill. You may not need to buy one of those things if things kind of slow down. So I've always felt like we were a bit of a canary in the coal mine. So when we see a slowdown as we do now, it will be before a lot of the big numbers that you see printed.
Raveen, is there an element of pull forward here? We are starting to see people switching to spending money on services. They bought a lot of stuff. Maybe they want to go out for the night.
Yeah, I mean, so your question is that can you? I didn't really understand that question.
Well, my question is, everybody's bought a lot of stuff. I bought all the pots and pans I need. I haven't been going out, as a result of which I've bulked up on that kind of stuff in my household. Do I need to go out and buy some more? Or am I, now that I am released from lockdowns, more willing to go out to a restaurant rather than cooking at home?
Yeah, I mean, I think that is potentially the case. But like I just said, during COVID, we were kind of a quote unquote recession-proof business, right? Because everybody needs to eat. But in this situation, I know, for instance, if I look at us as a proxy for how the consumer might be thinking, I would say that prices from my end are just going up and up. We raised prices something like 25% last year. And while I have not raised prices this year, if I had my druthers, we would probably go up another 10 to 15% based on what we're seeing from our raw material suppliers. The reason I can't raise my prices is it's very, very difficult for my clients at Amazon and at Walmart to get that stuff through, but I know it's coming. So I know that that will end up at the foot of the American consumer. And so to that point, I think that you might end up in a situation later this year where people aren't buying new cookware and they aren't going out to eat.
Well, I have to ask about the China situation. I believe GMM has 2 plants there. We're talking about COVID lockdowns and extension of restrictions in Beijing now. How does that affect the bottom line for you and arguably for other companies in your industry, the consumer industry that has this global reach?
So one of our plants is pretty well okay in the south of China. There's no lockdowns there, but the other one is in the north in the Shanghai area, and they are under total lockdown. And it's stark. I mean, when you know, everybody thought that this was in the rearview mirror, and China obviously was touting their ability to top down, you know, authoritarian systems work. And we were seeing pictures in Wuhan of thousands of people out while all of us in the States were locked down. And now we see that you know, this is a pretty tough disease and you can't really control it that well. So it is very, very tough right now in the north of China. And that extends to everything besides the demand that we don't see from a consumer perspective in Asia. It affects all of that logistics supply stuff that, you know, we keep talking about.
Raveen, did you see an impact from the start of the war in Ukraine on the business in Europe? Is it possible to draw a line between one and the other?
Well, we did have a few clients in Russia that we actually supplied to from our India facility. And, you know, obviously from a sanction perspective, we've stopped having that sales go on. I think the biggest thing from my perspective with Ukraine is just uncertainty. It's just yet another thing in an environment where it seems like every time you turn on the news, it's bad news. It's whether it's price increases, whether it's GDP shrinking, and now you have a war. I just think that people go, wow, we've had a really good 10 years, but maybe this is the time where we have to look, you know, maybe 2023 gets better. From my perspective, I'm an optimist, and I think that within 18 months, everything will be fine. I think one of the things that I don't see talked about is that economies sometimes contract. That's the way it works. And our government on both sides of the aisle has just not allowed that to happen for kind of the last decade. There's just been this extraordinarily big moral hazard accommodative situation. And now, you know, the piper has to get paid.
Raveen Gandhi, a really interesting conversation. GMM Non-Stick Coating CEO, thank you so much for joining us. More ahead, this is Bloomberg.
Okay, we are looking ahead now to the European close, the end of the week. Wow, has it been a long week. Let me just talk you through the price action, then I'll talk what we've got coming up in the next hour. European stocks are down, bit of a reaction to what we saw yesterday, obviously in the United States, and continue to see today. 430 is now the number. We continue to get dragged lower and lower, 1.85% off the pace today. Euro dollar, though, interestingly enough, catching a bid. There's been a lot of chat out of the ECB today about rate hikes. June, maybe not. July, quite possibly. We'll talk about that in just a moment. The other factor in all of this is what is happening with the Italian yields, which continue to push higher, and the spread bunds to BCPs also continues to go wider as well. We're around 200 basis points. Is there a pressure point coming? Is there a spread management issue that is going to emerge here for the ECB? We're going to talk about that in the next hour. We've got so much to talk about with our next guest, Jean-Claude Trichet. The former ECB president is going to be joining us. We need to talk about what's happening in the economy. We need to talk about how the ECB is responding, what the communication strategy is, and what it should do in terms of the core periphery management story. All of that is something that we need to be talking about. The euro is another factor that is worth dwelling on for just a moment as well. If we get to parity, how problematic is that going to be? Because obviously that's an important inflation factor that we need to think about as well. All of this, of course, in the light of the Fed this week and the Bank of England. Jean-Claude Trichet is coming up. We're going to be counting you down to the European close. That is coming up. This is Bloomberg.